According to Google Trends, such keywords as buy stocks have hit huge spikes in search volume recently. And this is a trend that you definitely don't want to miss out on. Welcome to my Stock Market for Beginners 2020 video. In this beginner's video, I'll cover everything that you need to know in order to get started trading stocks online. We'll take a look at such things as online brokerages, the different order types that you need to understand to get in and out of your positions, and also the different types of trading styles. All that in the video coming up. Traders from around the world, welcome to Real Life Trading. This is your host, JL Mussi, and I'm glad that you could join me in the Stock Market for Beginners 2020 video. First and foremost, make sure to smash that like button. Hitting that like button really helps us out and spread the message, spread our content, and help as many traders as possible. And these type of videos do take a lot of research and time to create. Also, make sure to smash that subscribe button and enable notifications so you are able to see the next time that Real Life Trading uploads the next video. And lastly, make sure to sign up for our Stock Market for Beginners complete course absolutely for free by checking the link down below, and all that information will get sent to your inbox. So without further ado, let's get started. So the first thing that you will need in order to start trading stocks is a brokerage account. So what is a brokerage account? Well, it's almost like a bank account, but those funds are directly allocated for the purpose of investing in the stock market. I like to lump in brokerage accounts into pretty much two groups. One is the old school group that includes brokerages like E-Trade, Schwab, TD Ameritrade. And then on the other side, you kind of have the new school, more catered towards millennials, which are your Robinhoods, your Webull, and your Acorns. And they've been known for different marketing strategies. Robinhood was the first brokerage that had zero commissions, so it was absolutely free. Webull, they actually give you free shares. And with Acorns, you can make purchases and they'll actually take the change that you have from those purchases. So if your purchase is $35.50, they'll round that up to $40. They'll take those 50 cents and actually allocate it towards shares. So it makes it real easy for beginning investors to start buying or putting money towards shares. And Robinhood put a lot of pressure on other brokerages. So a lot of brokerages started lowering their fees and pretty much going into price wars. And I remember years ago when I started with E-Trade, they were around $15, $12, $10 a trade. The price of the commissions went down, down, and down. And now even the old school traders, you actually don't pay any commissions, most of them, for trades. Not every single trade is absolutely free. So if you're trading options, for example, you do still have to pay for most brokerages to execute that. Most brokerages offer some type of charting software where you can do technical analysis on, and they also offer research tools. One thing to keep in mind, regardless of what brokerage you go for, the most important thing, in my opinion, for a brokerage is your order execution, right? How well they actually execute your orders. So, for example, for Robinhood, when the whole Rona situation came around, their app actually failed a couple of times, and that actually cost investors a lot of money. Now, I will say, depending on your trading strategy, and this is something we'll talk about in a second, but depending on your trading strategy, obviously if you're doing long-term investing where you just buy a couple shares and hold them, really order execution is not that important. But if you're doing something like day trading, it becomes very, very important. So depending on your trading style, order execution will be a bigger or a smaller factor. Once you selected a broker, created an account, it's time to fund your account. Sometimes it can take a couple of business days to do a transfer from your bank account into your brokerage account. Different brokerages have different speeds as far as the availability of those funds, but as a rule of thumb, plan for those funds to take a couple of days before you actually have them available and ready to execute trades within your brokerage account. and I will have links to all the brokerages in the video description down below. So once you have your online brokerage ready to go, it's time to start buying all the stocks that you possibly can, right? Not so fast. There is an option before you jump headfirst with real money called paper trading. Paper trading is an option that most brokerages have in order for you to be able to jump in the market, execute orders, but do it all with virtual money instead of real money. That is a good way for you to get acclimated to stock trading, to putting the orders in, to pretty much just getting in and out of positions. The one downfall of paper trading is that it doesn't really prepare your mind for trading, right? And what do I mean by this? Well, there's a big psychological factor of having real money on the line. And, when your trade goes sideways and you start losing real money, it's a whole different ballgame mentally. And if you're just getting comfortable with paper trading and using virtual funds, that's not going to truly prepare you for real trading with real money on the line. So once you're finally ready and comfortable to purchase and sell stocks, you'll have to know the different order types. There are many order types. I'm going to cover 3 of the most popular ones. So let's dive into market orders. Right now we're looking at the Uber chart on the daily time frame and pretty much just have my price action here and my volume here at the bottom. So right now we're looking at a candlestick chart, and these often give you much more information on the price action throughout whatever time frame you have. In this case, it's a daily versus just the regular line charts that you might be used to looking at Google or Yahoo Finance. So the candlesticks are comprised of pretty much 4 components: the open, the close, the low, and the high. So if we look at the price action here on May 12th, we see that Uber opened up at 31.42 and it closed at 32.40, right? So the body was between the open and the close. Since it actually went up, it's indicated by a green candle. On black candles, on the flip side, it means that the stock opened up higher and then closed lower. And on the green ones, obviously, we opened up lower and we closed higher. These wicks right here pretty much represent the lows and the highs of the day. So back to this day, to the 12th, for example, Uber hit the low at 30.41. And then the high of the day right here, right? It was 32.39. So basically what these represent is selling pressure, right? So the upper wicks represent selling pressure. It got to this point, but sellers pretty much pushed the price all the way down. On the flip side, on the lower side of the candle, right? This lower wick, this represents buying pressure. So this was the low, but buyers came in, stepped up, and drove the price back up. And that's how these candles are typically formed. So let's get a little bit more detail about the price action here. So I'm going to expand this here, and we're going to look at the ask and the bid. So the ask price is what the sellers are asking for that stock. On the flip side, the bidders, those are the people that want to buy, right? So if you ever used a website like eBay, right, you bid on an item. Well, right here, you're bidding on the stock. Now, you'll notice that there's actually a difference between the bid and the ask of 1 cent. That is typically referred to as the spread. And typically, the larger the spread is, or the larger that difference is, your market order will get filled somewhere in between, right? So if you have a very large spread on Uber, in this case we don't, but if we did, we actually might not get the greatest fill in the world. It might be somewhere in between. So this is how you would place the market order for Uber. You would set it to buy. You'd put the quantity of shares that you want. You will look up the symbol or the ticker. We want a market order. And you see, as soon as you put market order, it doesn't even give you the option for the price. It would just fill you at market price. And then for time and force, you could set it up for the day or pretty much just on market close, right? So we'll just set it up for the day. We'll review the order. And then as soon as you send that, you'll get immediately filled on Uber at the market price, which should be $34.20 at this point. Market orders are not something that we really recommend using all the time. They do have pretty much their instances where we do recommend them, but we actually have a better type of order that we like to use. So we're back looking at Uber on the daily chart. And right now I have my 10-day exponential moving average, which is a average of the price action for the last 10 days for Uber. It actually at one point was a pretty good support for Uber, right? Before we had the massive sell-off. So once we started selling off, you see that it actually became a resistance, right? Uber had a hard time closing above this average a couple of times. We come here to the March lows, and then obviously Uber had a strong bull run. So once we managed to regain that 10-day exponential moving average, right here indicated by these purple arrows are the places that Uber has bounced off this moving average. Obviously, we had dips below right here and right here. If you do technical analysis long enough, you'll notice that this happens a lot where old resistance, right, becomes new support and vice versa. And that's exactly what's happening here. And now we're back over the 10 EMA with good volume with a good close. So even though you might be bullish on Uber, instead of just getting in at a market order, right, and just rushing in to get into the stock, if you do basic technical analysis on this, you might actually set up a trade where you get filled in with another interaction, another bounce off the 10 EMA. And that's where the limit order comes in. Obviously, I have the power of hindsight here because I'm using a feature within TradingView that lets you rewind and fast forward the price action of Uber. And this is a great exercise if you want to do back trading and get better at technical analysis. A technical analysis is something that we cover in depth in our stock market for beginners course, absolutely for free. Just check out the link in the description down below. All that info will get sent to your inbox. So instead of you rushing to get in at Uber at 32.79, where this recently closed at, right? A better trade would be to play the bounce off the 10 EMA. And that's where a limit order would come into place. So I just fast forward one day. So the moving average is somewhat of a moving target. We could kind of see the slope of this. The moving averages tend to catch up to the pretty much the candles or the price action of the stock. So if I look at this, probably wouldn't want to put my order right here at 30.04 because I actually might get skipped. Something that I'm noticing here too is that this area right here was actually support for Uber at one time, right? It bounced here, it bounced here, and also it acted as resistance here and support here as well. So I think by looking at this, right, I know that the moving average will move up a little bit, right? And then I can probably put my order right here. This green line will be my limit buy for Uber. So in my broker, I would set up a limit buy, jump over here to my brokerage. I would look up Uber, and then I would set up a order type of limit. So I'll go in here, type in 30.47. Time in force is how long this order is going to be good for. I want this to set it up as good till canceled. So I manually have to go in, cancel this order, right? So when you do good till canceled, you actually have to remember or keep in the back of your mind that this order is still active. Since this is going to be a swing trade for me, and I'm going to play this out for a couple of days, this is going to be the approach that I'm going for. So I would go ahead and review the order and then place the order, right? So I'll go ahead and forward this. Now you see that we closed a little bit lower and the moving average is actually catching up. And that's why I wanted this to be slightly above the current moving average that we had of the day. So let's go ahead and go over one more day. So there's our fill. The low of the day for Uber was 30.41 and we would have gotten filled by 30.47. Obviously, I do have the power of hindsight here, but these type of trades where we look at previous price action indicators like this, support, resistance, moving averages, is something that we do all the time at real life trading. So we'll go ahead and see how this trade would have played out. And you see that we had a couple great bounces. So it's still respecting that 10 EMA pretty well. And there it is, right? So We gotten filled here, and that's almost a 4-point move from where we were. So this is a perfect example of how you would use a limit buy to actually get a much better fill versus a market order. We're still looking at Uber, still on the daily chart. And on Uber, a key area for Uber has been the $36 mark. So you see here, when it IPO'd, it bounced off the 36 area. It then closed below it, and it became strong resistance. And then now we're sitting back up here above the 36, right? So this is a key area. And let's just say you got into Uber around $37, right? And you're saying to yourself, well, you know what? Uber, this support right here, this 36 area is pretty strong. Last time we actually closed below it, we took a pretty nasty ride down to the $25 area. So to protect yourself from a big downside in your investment, you can set up what's called a stop order. So we'll go in here and I'll go ahead and just add a template. This is just a line with the word stop. Pretty simple. You can save templates within TradingView as well. But you say to yourself, well, gee, if Uber hits 36 again, it might just take that ride back down, and I don't want to be a part of that. So it's set to protect you. So let's jump to our brokerage and set that up. Stop orders are usually a sell order unless you're going short on the stock, and that's something I'm not going to jump into in this video. So this is going to be a sell stop, right? We're going to go ahead and put 100. That's the quantities of Uber shares that we have. We'll put in the ticker. And then the order type is going to be a stop market order. We have the time in force. This just tells the brokerage how long you want this stop order to be active for. If you're doing a swing or long-term hold on this, you probably want to set good till canceled, and then you have the option to set a date there as well. Let's see how this stop actually would have panned out. On the 25th, that stop got triggered, right? It broke that support that you had planned for previously. So if we kind of keep going forward here, it closed below the support, and it takes pretty much a historic ride down, right? We see that Uber pretty much bottoms out here at around $13. So this was a great stop placement on Uber, right? Just by doing basic technical analysis. Obviously, the stock came back and rebounded, right? But this would have saved you a lot of pain. So you could have got stopped on Uber around 36 and repurchased the shares, a lot cheaper before it made its move back up. Next on the list, I'm going to cover the 3 most popular types of trading strategies. First on the list is the good old long-term investing, aka buy and hold. And this philosophy was made really, really popular by none other than the Oracle of Omaha, Warren Buffett himself. Now, Buffett's hold game has been strong. This man can hold a position, hold a stock, and held stocks for decades. The whole Rona situation came, and his strategy changed a little bit.
So walk off, walk
Walk to the edge.
Walk to the edge. You didn't say that. I thought you meant jump over.
Or sit down.
Okay, walk to the edge and then hang. Okay, I get it. Let's go. Yeah.
That's probably another video for another time. So the basic premise of buy and hold is that good companies go up over time regardless of when you actually purchase them. So right now we're looking at a chart, a monthly chart of the SPY. The SPY is a ETF, which is pretty much a basket of the top 500 companies. And if we look right here at the allocation, you see that we have pretty big companies. What the SPY really tracks is the health of the US stock market. And you see here with these purple arrows, this is pretty much times at peaks where this is actually the worst times that you could have bought. But even if you bought into good companies at the worst possible time over a long period of time, you would still have made money. Most companies tend to follow the market to a certain degree, And over time, as the market rises, so does your investment in these good companies. So let's quickly break down the long-term strategy. This is going to be more allocated towards fundamentals versus technical analysis. So you want to buy into companies that have good revenue, low debt, pretty much a good balance sheet. Good balance sheet is important. Companies that don't owe a lot of money, they can survive, recessions or hardships like the ones that we're currently in a lot easier. These are companies that are less likely to go bankrupt. So having a good balance sheet, having a lot of cash on the side, having little debt, all these things are important. Growing revenues are important. The more that you understand that company, how they make money, the easier it's going to be to actually hold through hard times. And also, you will be the first to know when that product turns sour and maybe it's time to sell. A lot of times investors get into companies that they don't fully understand and they can't really gauge the product. And sometimes there is a shift in the quality of a product and the sentiment of the consumer towards that product. And if you can spot that early on, you could actually exit out of this position, right? And actually, save yourself from a lot of downside movement. And this really goes along with the philosophy that if you use that product, you are paid to be an investor versus a consumer, right? So, for example, if you buy a lot of Nike shoes, you like their products, instead of you paying Nike every time to get a pair of Jordans, a pair of Air Forces, a pair of running shoes, Nike can pay you through stock appreciation and through dividends. So let's look at some of the pros of long-term investing. It's hard to lose money if your time horizon is long enough. Obviously, you do have to choose a good company, but as we pointed out earlier in that chart of the SPY, even if you would have bought at the top of those markets, you still would have made your money back had you been patient and held that position long enough. Some companies do pay dividends. Dividends is a sum of money paid regularly, usually on a quarter basis by the company to its shareholders of its profits, right? So it's almost like you putting money into a bank account, and that bank account gives you a percentage just for having that money with them. Well, this is kind of the equivalent. So let's look at the cons of long-term investing. Sometimes you have to hold a position for months, years, or really decades. That's the whole point of long-term. So you will have to be patient. You'll have to be okay with a stock that moves downwards, that moves sideways, that's not always going up. And if you're an impatient person, maybe long-term investing can be hard. The second con would be is that you have a longer exposure to the market, right? So market conditions can change. Obviously, they changed in 2020 with this whole Rona situation. Maybe if we get out of this situation, market stabilize, next month we could be at war with China, with Russia, with any country. Maybe the killer hornets come out, destroy the country. So it could be anything. Your long-term positions are subject to the overall market and kind of the whipsaws and cycles that it tends to go through.
Next type of trading strategy is a swing trading approach.
This could actually be a couple of days, a couple of weeks, a couple of months, but it has to be more than one day. And I'll actually talk about that in the next trading strategy, why that is important. Usually with swing trading, you're looking for a catalyst, something that's going to push up the stock up or the stock down. You're looking for earnings, possible buyout rumors. You do a lot of technical analysis. You see if the stock is at a good support and you think that it'll bounce off of there. Maybe if you are in a biotech type of company, you are speculating on the FDA approval of a drug. Also, competition. Sometimes with competition enters a new market, there's a lot of movement in that stock. Perfect example is when Amazon came in and bought out Whole Foods. That caused a lot of ripples throughout the grocery business. I remember Costco, even though the revenue stayed the same, pretty much everything stayed the same with Costco. It didn't affect earnings or anything, but the stock just took a dive out of that fear that, a big player was coming into their space and a lot of investors sold. And none of the underlying fundamentals changed. So you could actually bought that dip at Costco And it was a great time because Costco actually did very, very well after that. So let's look at some of the pros of swing trading. You could actually start out with smaller capital, meaning that since you're doing a trade sometimes for a couple of days or weeks, if you're profitable from that trade, you could actually close your position and pretty much reinvest in the same trade or the same stock when it buys lower, or you could just reinvest those profits into another company or another setup. So this is a way of pretty much taking a smaller account, and through doing short time frames, you could pretty much flip your money in and out, and you can grow your account a little bit quicker. Another pro, in my opinion, is that you really don't have to be as patient as long-term holding. Meaning if you're somebody that's impatient, you like to lock in gains quicker, this might be a more suitable strategy for you. Let's look at the cons of swing trading. You have to be patient. Well, how can this be on the pros and the cons? Well, the reality is you still have to be patient enough for that stock to make the move that you originally planned. Usually with swing trading, what we do as real life trading is we plan in our entry, we plan in our stop, and we also plan in the target, the place that we want to hit, usually at a strong resistance point, but you do have to hold for it to get to that resistance, right? Sometimes the stocks can chop around, move sideways. Sometimes they can hit your target right away. Sometimes they can dip below your entry and then actually go ahead and ultimately hit your target. So you do still have to have a reasonable amount of patience for swing trading. The other con, just like long-term, is you're still exposed to the market. If you're holding a position for a couple days, couple weeks, obviously the market can move quick, especially when it comes to global events, to news. So you will have, anytime that you hold a position overnight, you are exposed to the volatility of the market.
And lastly, we're going to take a look at day trading.
Last trading strategy is day trading. You might have heard a lot of gurus. If you're on YouTube, you might get a lot of ads. This is kind of the sexy, glorified, often marketed trading style. So what is the premise? Well, the basic premise is, as the name implies, you get in and out at the same day. Usually day trading does favor high volatility, meaning that when you have big movements in the market, you can get good ranges to get in and out. The second premise of day trading is that usually you're looking for a small movement in that stock price, right? So maybe on a $30 stock, you're only really looking for a 50 cent to $1 move in that price for you to be able to reach your targets. Now, on the flip side, since you are looking at a small move in a share price, you actually have to buy a lot more shares. So this does require pretty much a large sum of capital. So let's look at some of the pros of day trading. You could grow your account exponentially, so you're in and out on the same day. That means you have a realized gain and hopefully not a realized loss. But if you have gains pretty much at the end of the market, you can take those profits and reinvest into your account, pretty much increasing your risk over time. And hopefully you can grow your profits exponentially. You don't have to wait weeks or months or years like swing trading or a long-term trading approach to actually lock in your gains. Second pro is that you're not exposed to market conditions. So no matter what happens, whether there's a recession, whether there's a new president, whether there's a new trade war, you're pretty much cashing in and locking in your profits at the end of the day, and you're not really exposed to the market volatility. And the third pro of day trading is you're liquid, you're all in cash. And this could actually help you sleep better at night, but it actually gives you a lot of options. So what does this mean exactly? Well, if you take a look at long-term investing where your funds, your capital is tied in for a very long time, day trading gives you a lot of options. You're all in cash. So if you see a good deal that maybe you want to go ahead and pursue a long-term investment at a good price, at a fair value, you could jump on that. If you see a good swing trading setup, you could jump on that as well. So it does give you a lot more options being all in cash. Let's look at some of the cons of day trading. You will need a large account. You will need a large bankroll, right? You are trying to capture a small move in a stock with a large number of shares. So buying a large number of shares require a bigger account size. Most brokerages require you to have $25,000 in order to be able to day trade. If you try to day trade with a smaller account or an account below $25,000, it will actually let you to execute a couple of day trades, but you will be severely restricted. And if you do it long enough, you can put your account in jeopardy and you will be flagged as a pattern day trader. And if you do that long enough without having the 25 grand in your account, they actually will put your account in a freeze for about 90 days. It's not fun. Trust me, guys, I've been there before. Second con of day trading, that it's very easy to lose money quickly. So you have to know exactly when to get in. You have to know exactly when to get out. If you're ill-trained for day trading, you will take some quick losses. Con number 3 is that you have to be very good at risk management. You are buying thousands of shares at a time. And if you don't have a stop loss in place, if you don't know your risk, what you're risking, and you're also disciplined enough to get out of that trade, once it actually turns sour, you could lose a lot of money. So risk management is key when you're doing day trading. You have to be very disciplined and have to have a high amount of mental fortitude. Watching your P&L go up and down like a pogo stick could actually be very, very stressful. So you have to be okay with the idea of sitting in front of your computer for a couple of hours, being disciplined enough to see your account actually diminish, sometimes quite a bit, and be disciplined enough also to hold and let your trade setup actually play out and hopefully hit your target.
That's the end of the video, folks. Thank you so much for tuning into the Stock Market for Beginners 2020 video. Make sure to let me know how I did in the comment section down below. Smash that like button. Make sure to subscribe to our channel. And until we meet again, folks, I will catch you next time.